Tina Mitchell here with your Money Chat. The Fed hiked federal funds rate by 0.25%, just as expected. Looking at the dot plot chart, most Fed members are expecting 7 additional hikes this year. There are 6 remaining Fed meetings this year, which implies that there would have to be a double of 50 basis points hike at one of the upcoming meetings. The Fed rose their 2022 inflation expectations by 65%, from 2.6% to 4.3%. They also revised GDP lower from 4% to 2.8%. The big negative for mortgage bonds, which mortgage interest rates are directly tied to how the Fannie Mae 30-year bond is trading. The Fed's comment on the $9 trillion balance sheet. The Fed said that they would start to reduce their balance sheet at the coming meeting, and in the Q&A session, Powell said that they may finalize their plan at the next meeting. Inversions on yield curve. I have been tracking the spread between the 10-year yield and the 2-year closely and have shared before when that goes inverted, it's been a reliable recession indicator. Normally, you would expect to see a revised higher rate of return for putting your money away for 10 years versus 2 years. But when there is an economic slowdown and fear of what's happening in the markets, the yield curve can go inverted, meaning that the 2-year yields are higher than the 10-year yields, which is backwards and upside down. Looking back at the history of recessions, we always see an inversion occurred ahead of a recession, although it could take 6 months to 2 years for the actual recession to occur. Now, while we are not seeing the 10-year and 2-year spread go invert yet, it was dropped by 18 basis points. Now, when the Fed hikes rate, this causes short-term yields to rise and causes the long-term yields to fall if it's perceived that the rate hikes are getting the inflation under control. We are not seeing long-term yields fall yet, but short-term yields are climbing. And while there is not an inversion between the 10-year and the 2-year, there are other inversions that are happening in the yield curve. Currently, the 7-year yield is higher than the 10-year, with the 5-year yield at about the same level as the 10-year and the 3-year yield 3 basis points beneath the 10-year. Additionally, the 20-year yield is above the 30-year yield. Now, on the housing front, the NAHB Housing Market Index for March, which measures builder confidence, dropped 2 points from 81 to 79. Current sales fell 3 points to 86, which is still very strong. Buyer traffic increased 2 points to 67, which is also showing strength. The real decline came in future sales expectation, which fell 10 points. This is likely due to supply chains, labor costs, geopolitical uncertainty, and higher interest rates. A reading above 50 still signals expansion, just on a slower pace. Now, while the NAHB showed builder confidence fall, Lennar, the largest U.S. home builder, reported that they are seeing very strong demand on all of their sites and expect that sales are going to increase in 2022. Housing starts increased 6.8% in February at an annual rate of 1.77 million, which is almost double expectations and the highest in 16 years. Year-over-year starts are now up 22%. Single family, which is most important, increased by 5.7% and are now up almost 14% year over year. Permits fell 1.9% last month, but are up 7.7% on a year over year basis. Single family permits fell 0.5, but are up 5.4% year over year. Existing home sales report that is coming out will be important, especially the level of inventory. Earlier in the week, Zillow reported only 729,000 homes nationwide in February were available on the market. The previous existing home sales reported 860 homes for sale in January, which was a record low. In the report from NAR, follows the decline that we saw from Zillow report, we could see tight inventory picture and getting even tighter. This will make it hard to find a home, but should continue to support the home prices despite the higher interest rates. Now, on the employment front, initial job claims, which measures individuals filing for unemployment benefits for the first time, decreased 15,000 to 214,000. Continued claims, which are those that continue to receive benefits after their initial claim, decreased 71,000 to 1.4 million, which is a low going back to 1970. The labor market remains tight and employers are holding on to their workers. And that's your Money Chat for this week.